Give us like your hallmarks of an innovative growth company. What you're looking for, and then maybe if you can weave in some examples as
Yeah,
you
sure.
go. Yeah.
So we're looking for businesses. We're looking for businesses that are quality. So they're generating, as I said earlier, they might have manageable debt or little or no debt. They've got high rates of return on equity and/or very high margins, gross margins or EBITDA margins. Then they've got tailwinds. They might have a tailwind. So two examples of technology businesses that have tailwinds, and they're therefore not as beholden to economic conditions. Two would be Macquarie Technology, or Technologies, which is the old Macquarie Telecom Group. Macquarie Telecommunications, and the other one is Megaport. Now, both of these businesses have the AI and cloud computing tailwind behind them. The reason why I think they're ideally positioned in Australia is because the enterprise migration to the cloud, and enterprise, when I say enterprise, I mean very, very big businesses, very, very big businesses moving to the cloud is where mobile smartphones were 10 years ago, 8 or 10 years ago. We're still only probably halfway through that process. And so you're going to see more and more demand for cloud computing as these enterprises switch to the cloud. You're also seeing a lot of small businesses move to the cloud because it's egalitarian. What it does is it levels the playing field. It used to be that big businesses who could afford a data room, and a room as big as the one we're in now, full of racks and servers, only the companies that could afford that had great websites, and only companies that could afford that and install those racks into their offices, into their premises, could produce a great UI and UX for their customers. And now, in the cloud, everyone's the same. It levels the playing field, which is extraordinary. And so that's why the demand is going to keep building for cloud computing. Now, Macquarie Technology Group, or Macquarie Technologies, they have a data centre in Macquarie Park, near Epping in Sydney, and they're expanding the capacity. They're building the third centre. It's called IC3 West. They're building the third data centre, but they've also upgraded its capacity by about 41%. And they generate 75% margins. Now, they work for, the hyperscalers, the Googles and the Amazons of the world. They work for Fortune 500 companies. That's who are tenants in their data centres. And also about 42 or 43% of the federal government's departments. So they're a high quality provider. So they're expanding capacity, and eventually they'll be full. And when they're full, they're like a REIT. They're like a real estate investment trust with class 1 tenants. And the demand is enormous. And that demand is meeting limited supply. Now, people will say to me, no, well, supply's not limited, Roger. Supply is increasing. There's billions and billions of dollars being invested in data centres. But a lot of the best sites are already taken. You want a data centre. If you're an enterprise, you want to be with a data centre that's close to where you're located, so your latency is the lowest it can possibly be. And so these ideally located data centres, that real estate's pretty much taken. The other thing is it takes time to build data centres, but the speed with which demand is increasing or accelerating is much greater than the demand can keep up. And so when rising demand meets limited supply, or supply that's growing slower, then prices go up. So there's an opportunity to raise prices. And again, 75% margins on every dollar of revenue, which is really attractive. Then on top of that, you've got AI. And AI will simply, it's an exponential increase in demand for the use of cloud computing. If I've got Microsoft Word and I'm typing an article for the Australian newspaper, I connect with the cloud when I open the document, and I connect when I save the document. If I've got Grammarly or some other editing software, then I'm connecting a bit more frequently. But if I have Microsoft's Copilot installed, which will be released later this year to everybody, it's in beta release at the moment. If I have Copilot, What Copilot's going to do, it's going to sit on my shoulder watching me write my Word document and say to me, hey, Rog, do you realise that you've said this a bit nicer before, or you've said this in a way that was more approachable before? Would you like me to show you how you've said it before that was better than this? And here are 4 examples. So it's gone to my previous documents and looked at all those documents, read all those documents, seen what I'm writing now and said, oh, you've said this. Or if I'm drafting a really short email, it might say, Roger, that's a bit terse. Do you, do you want to say that a bit friendly? Here's 5 ways you could say it friendly, and it still sounds like you because I've accessed your previous emails. Think about how many hundreds of times a second or thousands of times a second I'm now communicating with the cloud. But the consequence of that is that the demand is exponential and companies can charge more for it. That's why we like this company. Now, we also think it's good value. So we think it's currently trading at $75 or $80 at the moment, around that price. I haven't looked at it in recent days. We think with a 9% discount rate, it's probably, knowing what we know about the capacity increases that it's got and what it charges for that capacity, we think it's worth between $100 and $115 a share. And it's trading at $75 to $80. Here's the interesting thing though. Once it's full and it's just throwing off cash like a residential property with a tenant in it, but with class 1 tenants, we think that there are superannuation funds and pension funds around the world that won't be using a 9% discount rate to value these things. They'll be using 6% weighted average cost of capital, because they're paying their superannuants, their pension investors, 3% or 4%. And so they're happy to pay much, much higher prices for these assets. And in that scenario, and that's a hypothetical, of course, but in that scenario, we think Macquarie's worth, $180 a share, not $75 or $80 where it's trading at the moment. So that's the thesis for a company like that. The other one that I mentioned was Megaport. I won't go into as much detail because I realise we're limited for time, and I do have a few other stocks to talk about. But you look at Megaport. Megaport is Sweden in the world of data centres.
Okay.
Right. So if you're an enterprise, you're a big company, you're a Price Waterhouse, or you're a KPMG or something. You've got an office in Sydney, you've got an office in Hong Kong, you've got offices all around the world. All of those offices want to be close to their own data centres for the latency issue that I described earlier. But it might be that the Hong Kong office is connected to AWS, Amazon Web Services, and here in Australia you're with Salesforce or someone else. Those data centres, those suppliers, they don't want to talk to each other, and they don't want you talking to their competitors, so they don't make it easy. What Megaport does is provide the hardware and the software for you to be able to, for the Hong Kong office to talk to its data centre, and for you to talk to your data centre, and those data centres to talk to each other, and you feel like it's completely seamless. That's in essence what they do, and they are class leading. They're genuinely world leading on this. And so we think, again, they're another business that's worth far more than where they're trading. And they are the world leader on that. A third business that we think is remarkable and other people think is expensive, and we don't, is Audinate.
Oh, yeah.
Now, you guys would know Audinate's Dante software really
Roger,
well.
this one kills us because back when we were doing our show on AusBiz, and you probably spoke to us about Audinate when you came on AusBiz, and neither of us bought. And it's been a few years, and it's just run.
Well, we think it's still got more to go because...
What is it? Isn't it just like digitizing cables?
Essentially what it's doing,
I mean, they're not putting that in their investor presentation.
So all the audio, all the command, all the controlling is migrated from different cables, HDMI and fiber and whatever, into an Ethernet system, and it just simplifies the installation, it simplifies the problem solving, it simplifies everything. And that's why it is now the world's leading solution. And so whether you're Bosch or you're, Bang & Olufsen or you're Yamaha, there are literally dozens of OEMs manufacturing audio equipment that now have embedded in their hardware Audinate's Dante solution. Now, where we think the upside is not just the rollout globally.
Before you talk about the upside, just to give context for why the market might think it's expensive, it's trading about $20 a share, and its PE ratio currently is about 100.
Yes.
So with that
I
context
actually thought it
in
was
mind-
144.
Okay, I might have sold off a bit.
But if you're growing your earnings, if you're growing earnings at double-digit rates, high double-digit rates, then in theory, just the theory, if you're growing your earnings at 50% a year, then you're potentially halving your PE each year, right? So I'm less worried about that. Now, what they're doing is they're migrating, or they're moving that Dante technology. They're bringing it to the visual side of a delivery of a concert or a conference or whatever. So it's not just going to be the audio; it's going to be the visual side as well. And that's far bigger than the audio. The opportunity there is sizable, and so we see Audinate as having significantly more upside than what people are currently giving it credit for. We love that people think that it's expensive.
But I also think people are giving a lot of credit. It's up 131% in the last year.
Yeah, that's right. So it is up a lot, but we still think there's upside.